They're calling it the Monday Massacre, the worst drop in Wall Street history.
One Monday in October 1987, global stock markets suddenly crashed.
Hour after hour today, wave after wave of selling hit the stock market.
The fear index just spiked. About 50 CEOs are sounding the recession alarms, and the Dow dropped over 2,000 points. But what if I told you this market panic is creating the easiest money-making opportunity in about 20 years? History shows this could be the exact moment to position yourself for a 40% upside within the next 12 months. But only if you understand what's happening behind the fear while others flee. Felix here, and I'm going to say this week has been absolute madness on Wall Street, hasn't it? BlackRock's Larry Fink just issued a stark recession warning yesterday, and the markets are, well, in a bit of a tailspin, although stabilizing slightly as I'm recording this. But for those of you short on time, or who've just burned away the brain cells on TikTok or just refreshing the portfolio every 2 seconds over the last few days, here's what you need to know. I'm analyzing whether this market panic represents a genuine, huge buying opportunity, or is it a false bottom? The data suggests we're seeing classic capitulation signals that have historically preceded major rebounds. And in the next few minutes, I'll show you exactly how to read these signals and position yourselves for the recovery phase that typically follows such extreme fear readings. And look, for years, I've personally witnessed how these moments of maximum pessimism create extraordinary wealth for those who recognize them. And you'll notice I'm not starting with the basic concepts that you already know here. Instead, let me share a crucial insight with you. Market bottoms are typically characterized by 3 signals occurring simultaneously. Extreme volatility readings, so extreme fear. Institutional investors panicking and capitulating. And third, peak pessimism in financial media / social media. And we're seeing all 3 right now. Just as we did in March 2020 before the market surged 120% over the next 2 years. Winston, my trusted adopted golden retriever, inspired a useful analogy here. When he gets anxious during, well, actually, he doesn't really get anxious much, but let's just say some dogs get anxious during thunderstorms, and their behavior becomes a little bit erratic and unpredictable, much like the market during crashes. But the storm always passes. The normal behavior returns. In fact, Winston actually likes to run out in thunderstorms. He likes the water and the mud and the puddles. But anyway, the key is recognizing the storm's pattern and duration. So maybe not the greatest analogy in the world. Now, speaking of patterns, the greatest investors in the world understand the patterns of the market. And by greatest, I don't mean smartest. No, because it's not about smarts. It's not about ability. It's about knowing those patterns. And I've learned those patterns from my mentors. I was very lucky. I was a banker for a little while and I managed my own money for the last decade plus, and it's gotten me to a place where I could retire in my early 40s. So identifying these market bottoms through years of experience here is what I've been up to. And in fact, it's the exact methodology for spotting high probability market rebounds that I actually teach. I teach it for free. Why? Because it's fun, it's satisfying, it's amazing to see everyone saying, this is incredible, you're saving my portfolio and I'm now making money. That's my goal here, by the way, make 1 million people financially free. So if you want to learn those patterns and spot how to spot that bottom and where the next rally kicks out, leave this video right now and go to felixprehn.org/get-free, because there you'll find a 15-minute video, probably shorter than this one, the way we're starting this one off at least, and you will learn those exact 3 rules, and that'll be way, way, way more useful than me telling you how I'm interpreting it right now, because rules are skills. This is my interpretation and my opinion on some news that ages pretty quickly. The school skills and the rules you'll have forever. So head over to felixprehn.org/get-free and let me know that in the comments. Just write free in the comments because you want to get free. So let's get back to the Fink, the BlackRock CEO. He stated that most CEOs he's in contact with already believe the US economy is in a recession. Now, when someone who manages over $10 trillion in assets says something like this, well, it tends to move markets and expectations. The psychology of markets is rather fascinating. When I was a banker, we used to have the saying, markets take the stairs up and the lift down. And we're certainly seeing that elevator drop right now, right? If we look at the fear index here, that's one thing I'd always watch. It skyrocketed it went all the way up to 59. I'm showing it to you on the screen here. It's come down a little bit as I'm recording this. It's at 43. But a normal reading on the VIX is below sort of 15. That's about normal. Right? 17 is all right. Anything above 20, and we get a little bit itchy. Right? So we're seeing levels comparable to the 2008 global financial crisis and the beginning of the COVID pandemic. So this is crisis level fear we're witnessing here. Maybe people are just not made of the tough stuff anymore, but that's the reaction. And there is more to this story. President Trump has just threatened an additional 50% tariffs on Chinese imports, which is pretty massive. But what's particularly interesting here is, and perhaps more concerning, is that Israel was notably not granted a tariff break, even though Netanyahu flew to the White House and begged on one knee or something like that. I'm not saying he actually did that, but you know what I'm saying, right? One of the closest allies the US has ever had, and they're not getting an exemption. So who's going to get one? Maybe nobody, right? So we've just got this perfect storm. Recession warnings from Wall Street's finest, volatility fear indices at crisis levels, and trade tensions that could just dramatically reorder global supply chains. So no wonder markets are in a bit of a panic. And this is crucial. I've analyzed market data going back decades. And do you know what I consistently found? These moments of extreme fear create the most extraordinary opportunities for those who can keep their heads while others are losing theirs. Right? Now, I'd like you to take a screenshot of the next slide. It shows the correlation, pay attention, between VIX spikes above 45 and subsequent 12 months market returns. And this pattern has been remarkably consistent, and understanding it could make an enormous difference to your portfolio performance these next few months or years. So let's look back at some historical crashes here to understand what lies ahead, because as Mark Twain allegedly once said, history doesn't repeat itself, but it often rhymes. And my goodness, the rhymes are seeming rather striking. So let's start with the granddaddy of all the crashes, the 1929 crash, the one crash all other crashes are jealous of, right? This was the market collapse that defined a generation. Speculative excess, margin trading running wild, and virtually no regulatory oversight created the perfect condition for disaster. I could have described probably the crypto market there, but no, it's 1929. And what's fascinating is that while the Great Depression that followed was devastating, investors who deployed capital in the deepest point of pessimism eventually saw returns that would be considered almost unbelievable today. The lesson: even the worst economic conditions eventually improve and markets recover dramatically, usually. Now, fast forward to 1987, October 19th, Black Monday. The Dow and the S&P dropped 20% in a single day. Can you imagine that? Your portfolio losing a quarter of its value almost between breakfast and dinner. It was largely triggered by computerized trading programs, creating a cascade of sell orders. But here's what's remarkable. The market stabilized relatively quickly, thanks to intervention from policymakers. And within 2 years, most of these losses were recovered. And then there is the infamous 2008 financial crisis, something I experienced firsthand. And the housing market collapsed, right? Thanks to lots of widespread fraud, taking with it numerous financial institutions and the jobs of quite a few friends. And they'd all gorged themselves, not the friends, but the financial institutions, on subprime mortgages. And this time, government bailouts and aggressive money printing from central banks essentially restored stability. But, and this is critical, investors who bought quality companies during the horrors of that crisis saw remarkable long-term returns. And most recently, we had the 2020 pandemic crash. Everybody remembers, right? If you remember the COVID crash, put a C in the chat down below. We don't want to spell out the whole thing now. We got unprecedented fiscal and monetary stimulus, which has allowed the markets to recover at an astonishing rate. So what's the common thread here? Market corrections, even the most severe ones, have consistently created extraordinary long-term investment opportunities for those who recognized the opportunity. So markets tend to overreact to fear. It's human nature, right? So it creates these asymmetric risk-reward opportunities for contrarian investors with a good stomach lining. So write this down. The structural drivers of each crash were different. speculative bubbles, external shocks, fraud, all sorts of stuff. But the recovery trajectories show a consistent pattern, which we can exploit right now, right? So patterns start to make some sense to you. Now, understanding that, guess what? You already know more than like 95% of retail investors. You're just currently in that panic frozen stage. So let's get into some proper data, right? Because making investment decisions without data as well, it's like trying to navigate your way around the world without a map. It wouldn't really work very well. So here's another table that analyzes 15 historical instances where the S&P dropped daily with losses greater than 4.5%, precisely the kind of downturn that we're now seeing. And the results are remarkable. Look at what happens. Just 1 week after these sell-offs, in 73% of cases, the market delivered positive returns. That's extraordinary if you think about that, right? So write that down. When we extend the time frame to a month later, the probability of positive returns jumps to 87%. They made 8.5% in just 1 month, which is pretty good. And then if you look at 6 months, well, 6 months later, after these panic-driven sell-offs, the market was positive 93% of the time with an average gain of 17%. Let me repeat that. Write this down. 93% probability of a positive return with a 17% average gain 6 months later. Those are odds that would make any professional bookie take notice. But what about the longer term? Well, a year later, the results are a little bit more mixed because, well, the average gain was now 40%, right? It's huge. So take a picture or a screenshot of this next slide here with your phone. It shows the complete trajectory of recoveries across all the 15 historical crashes, color-coded by decade. And notice anything, the pattern is remarkably consistent, regardless of what caused the crash, how long the crash lasted, any of that. So how does our current situation stack up against these historical patterns? Well, the alignment is striking to say the least. Today, VIX reading at, as I'm recording this, 43 is firmly in extreme fear. So if you look at the historical data, what happens after the VIX is in that 45-ish sort of zone since 1997. That's all the data we've got here. Again, we got a positive return 83% of the time. Just 1 week later, average gain is 4%, which is pretty good. So it's pretty compelling, isn't it? But I should note there has been an exception. September 2008 saw the market continue to decline after the VIX spike. So no pattern is foolproof. I'm not saying that there is no risk. If you want no risk, I can't really help you. But let's connect the dots a little bit more. Larry the Fink of BlackRock is giving us that recession warning. And we've got incredible uncertainty around Trump's tariff policies. So remember the trade tensions of 2018, 2019? The market ultimately reached new heights after those concerns were addressed and somewhat solved. So if you look at all this data together, and it's a lot of data, but I just wanted to make sure you guys are really, really well informed and you're getting some tremendous value here. If you look at the textbook quote from Baron Rothschild, you know what he said? He said, buy when there is blood in the streets, even if the blood is your own. So the contrarian investment principle is counterintuitive. It doesn't feel good. Nobody wants to buy cheap stocks. Just doesn't feel good. Weirdly, everybody wants to buy them at an expensive price. It's really, really odd. But buying when others are fearful, precisely when your instincts are screaming at you to sell, is historically data-backed the one thing that makes you a lot of money, provided. And there is a big proviso here, because this idea of easy money, it should always come with some significant caveats, right? First and foremost, you must acknowledge that persistent recessionary pressures could dampen any recovery speed. And if Larry the Fink and other CEOs are correct about the economic downturn, and earnings might slow down and all of that, so we might see a market turnaround that is much delayed. Remember, during 2008, many jumped in at what they thought was the bottom, only to watch markets decline another 20% before the actual recovery began. So timing is difficult. It's not a precise science. The escalation of trade tensions we're seeing, particularly with China, could potentially extend to other trading partners, and it could make the whole thing a lot worse. We might see inflation coming back up, right? So what am I doing? I'm waiting for that VIX number to come down, and then I'm going to start buying a lot of stocks. Now, individual stocks will always recover faster than the index. But the safest thing to buy is the index, because the index can't go to zero, right? Any stocks can actually go to zero. The index will not, because S&P 500, 500 companies, even if 20 of them go bankrupt, 20 new ones get added to the index, so you end up owning those. But there are some industries that are going to rebound much, much faster while others will lag. And the uneven performance makes stock selection particularly crucial in the current environment. We've been in a stock pickers market for at least 2 or 3 years. And what's the appropriate strategy? Well, I've developed an approach that I believe balances opportunity with prudence. First, diversification, but just not for diversification's sake. We want to spread our risk across multiple assets and multiple sectors, but we want to be in the good stocks because most stocks are just not good. And think of it as putting all your baskets in one egg, the other way around. You know what I'm saying, right? It's just not really something we want to be doing. And then second, focus on quality companies, resilient balance sheets, real competitive advantage, and cash, and cash flow. So I think this might be a Buffett quote: when the tide goes out, you see who's been swimming naked, and you don't want to be in those stocks. And then we have risk management. And there is a simple thing, gradual exposure, so dollar cost average. Say you have $10,000 where you want to invest, you put $2,000 into the market every week or something like that, and now we are spreading it out at least over 5 weeks. There's no right or wrong there, but it just makes you sleep a little bit better at night. And it's a bit like Winston. When he was a little younger, he'd see a new dog in the park and he'd just race at him in full speed, like just lunge at the poor beast. And he will inevitably try and bite him in the face, which was sort of the appropriate response. Whereas now, Winston sees a dog, he has grown up a little bit, he sort of walks at him in a slow way, he sniffs around a little bit and says, "Hi, I'm not dangerous." That's sort of the same thing here as the approach that I'm suggesting. Now, what about something a bit more defensive? Not everything is tech. We've got consumer staples. We've got utilities. There are sectors that don't sound sexy, but that tend to outperform in recessionary phases or phases where we fear in recession. So these are like the stabilizing keel on the sailboat if you're a sailor, and try sailing without one. It's not really a pretty experience. And then most importantly, monitor the policy signals. Any adjustment in interest rates, taxes, or easing of trade barriers could really, really influence market direction. And these policy shifts often precede major market moves. Easiest way, I think, to watch all of that is just to watch the VIX and save yourself from reading all that gibber, because it'll just tell you, is there fear, is there no fear? And then you'll know what to do. Now, let's have a quick look at the stock charts here. And obviously, by the time you're watching this, you might be a few hours ahead of when I recorded this. But regardless, I think this is going to be very, very useful. So let's start off with the SPY, the SPY, right? And I'm assuming here that you are more of an investor, and this is inside Trade Vision. And if you turn on these little trend signals here, it gives the bullish signal and then the bearish signal. And the bearish signals are our risk management points. And you might think, well, why didn't you just hold the whole thing? Well, if you'd done that over the last 2 years, you'd be up 5%. We'd be up 25%. So we're doing a little bit better by having risk management. And we kicked in a very nice bearish signal up here, which was at around 400, 500, what was it? A little hard to read, isn't it? What did that say? 594, which was our exit. And that kind of made sense because it's also this blue long trend line that I've drawn in here. Now, right now on the index, we are below the 200-day moving average line. And that's probably the one moving average line, if you're a long-term investor, you're going to want to get to know and you want to make friends with, because that one's going to really matter. And it's that brownish line there. That's the 200-day moving average line. If you want to toggle that on, it's a little thing down there. So that gives you a little bit of perspective. We're in pretty deep waters. This is pretty unpleasant. We've had gaps down. We had one gap down, 2 gaps down, thankfully none yesterday. And as of today, when I'm recording this, at least the pre-market looks somewhat optimistic, but obviously that'll depend on the latest tweet from the orange one in your Oval Office. So what do we do with this? Well, the optimism from yesterday is sort of there, but it isn't that big. Why? Okay, so we started yesterday down here, right, the bottom of that candle, and we ended the day at the top of that fat bit of the candle there, right? That was it. We did that on massive, massive volume. So we moved up a little bit during the day, which was somewhat positive. It's a little bit like stabilizing. So it looks like we might open a bit better today. A little too early to tell. We often get this kind of candle where we do in effect still close below the previous day on massive volume, and that sort of washes out the final people who want to sell, but it looks a little bit better. Now, what I don't like about that particular setup is that we were quite a lot higher during the day, and then we dropped quite a lot lower. Now, that was a lot to do with the fact that there was this slight interview cock-up where I think it was Bessent who was asked, do you think Trump would consider a 90-day pause on tariffs? And he said, yes. And he just meant, can you repeat the question? And then it was obviously misinterpreted. So we went through this absolute mad zone in the market here where we went, 8% up. And then we went just a few minutes later down another 5%. Now, if you're a conspiracy theorist, you think somebody might have known something about that, because if you actually look at the dark pools, and I'm not sure I'll be able to find that trade because there were so many yesterday right now, but we have that dark pool data in here. You can see all of the individual trades. There was somebody who placed a massive, literally at the top of the market here, a massive $1.2 billion trade for this to go down, and then obviously retired about half an hour later and has been seen shopping for houses in the Hamptons. So somebody made a lot of money out of that, and then obviously the market sort of did all right. It wasn't terrible, but it did all right. But at least if you look at the market trend and you ignore that bit of noise there, you are getting to somewhat of an upward trend here on the day, which we haven't seen in quite a while. So that could be the little bit of stabilizing news that we might actually want. Now let's have a look at the Qs, the NASDAQ, the QQQ, and that is the day there as well. So again, you see that spike there, that was that kind of noise, but overall there is still somewhat of a positive trend here in the day. And that has me feeling a little bit optimistic, but also not overly optimistic because it is just one day and the whole thing does depend on politics at this point. And then we go back to our good old friend, the VIX, which never lies, has no, it just gives you the plain old facts of fear. And right now we're about 23 points higher than we need to be to instill some confidence in the market. So while that is up there, I'd be very cautious. So if you have somebody with a very long time horizon, and you have a very strong stomach lining and you've got good cash flow, which means you can go and buy stocks every week or something, then nibbling now isn't the worst thing to do, provided you don't mind that it might go down another 20%, right? Could do that. If you're a little bit more cautious and more careful, then you might want to wait a little bit longer, because being late is a good thing in the market. We are always a little bit late on every opportunity. We don't want to be really, really early. That's kind of what I would look at. Just indices will be the safest thing to do. And then I'm going to keep sharing with my mentees in our private community about the individual stocks that I'm looking at, because I think it's important to be, to show them how I apply the rules. And those will be, a little bit more risky. Here's one, for example, that I'm looking at the moment. Celsius Holdings, some really good numbers underneath there, and it's done pretty well through this whole crash scenario here, right? So there are always opportunities, and it sort of falls almost into the consumer staple sort of thing. And people I employ a bunch of people and they all seem to consume some serious amount of Celsius. I've never tried the stuff, but apparently it's highly addictive. Otherwise, they wouldn't keep drinking it. So there are always opportunities out there if you know what to look for. And I just want to encourage you to use this moment of pain, because let's face it, that's what it is to 99% of people out there. If you're not feeling pain right now, you are either super well informed, amazing, well done, as in well trained, or you suffer some sort of weird psychiatric condition, in which case, please report yourself to the next lunatic asylum, or run for government office. That's probably also a good thing to do. And take just the next 15 minutes to actually learn the rules where we buy, right? Because there are rules for this. And once you understand the rules that the most successful investors out there have been using for decades, I didn't make this up, then you'll be in a much, much better position to benefit from the inevitable recovery that'll come when this crash is over. Is the crash over today? Don't know. Nobody knows. People tell you that they know, but it's just a cheap way to get your attention. Nobody's got any fucking idea whether this is the bottom of the market. It could go another 20% down. But we can look at a couple of things that I've walked you through here to give us more confidence and allow us higher probabilities of making money. You don't know whether you're going to make money by tomorrow. That's what I'm saying. So there's a high probability you make money in a week or in a month or in a year, and in 5 years, 10 years, the probability gets higher and higher and higher. Does that mean you can't make money in the short term? No, of course it doesn't mean that. Otherwise, Wall Street wouldn't exist, right? Nobody shows up to Wall Street and says, look, what, guys, let's just invest our money and come back in 10 years and we'll go home. They don't do that. No, they aim to make money every week and every month and every quarter. And once you understand the rules, you have a much, much higher probability of actually achieving that while protecting your capital and protecting your money. So if you got some value out of this, go watch felixprehn.org/get-free, share it with a friend or two or five or a golden retriever. And I wish you a tremendous week. All the best.
President Trump's tariff chaos sending the stock market down this week with record lows. NASDAQ closed in a bear market for the first time since 2022, down more than 20% from its record high just this past December. And the Dow posted its biggest back-to-back losses since March. The S&P fell